Anyone who has money wants to see it grow. But first, let's consider the most fundamental question. What does it mean to be wealthy? Is it operating a BMW? Enjoying fine dining? Or embarking on opulent cruises? These are merely the cherry on top. True wealth is the accumulation of sufficient funds to guarantee a bright financial future. Finally, how can we get wealthy? Have you ever wondered what characteristics wealthy individuals share? It is, of course, their perspective on money and a little bit of luck. Rich people invest with a long-term outlook and are not discouraged by the short-term ups and downs. To grow your money, we have come up with 8 of the best ways one can grow his money to its full potential. Before starting, don't forget to like and subscribe to our channel for more future updates, so let's start. Number 8. Get expert advice how to grow your money. If you're unsure of your personal financial objectives and goals, you should seek expert advice or speak with a family member or friend who is skilled with numbers and has a track record of successful money management. Let a financial advisor examine your finances and make investment suggestions. Based on your needs and investing preferences, you might use it to develop an investing plan. Number 7. Put your fear aside. No one ever learns to swim without entering the water. Therefore, you must set aside your fear and begin investing if you want to increase your wealth. It might be equivalent to risking everything to do nothing. Many people believe that saving money is equivalent to investing it. It isn't. If you decide to invest your money instead of keeping it safe in a savings plan, you risk having your money outpaced by inflation and losing value. Number 6. Invest smartly. Avoid falling for the glitzy investment advertisements. When choosing an investment, rely on your own judgment and knowledge. Never invest money in something you don't understand, and never invest more than you can afford to lose. Instead, resort to assets that suit your appetite. If you don't want the ups and downs of the stock market to eat away at your hard-earned funds, then you should invest conservatively. On the other hand, if you're an expert at navigating the market's lows and highs and making the most of them, the stock market may be your thing. Put your money in tax-saving investments like the National Pension Scheme known as NPS, Provident Fund, ELSS mutual funds, and so forth to try to make the greatest investments possible. Number 5. Start early. Banyan trees take several years to reach their full capacity. It requires time. Investing is the same way. The more time the investment has to grow and the greater the likelihood of financial growth, the earlier you begin investing. In a way, investing is something you should have always begun doing earlier in order to build your money. Consider setting an early retirement age of 55. And retiring with a sizable sum of money for yourself. Let's take it a step further and say you decide to set your goal savings at 5 million rupees. Now it is clear to see that if you start investing at the age of 25 rather than 35, you will need to pay a smaller amount each month to grow your money. Starting early always pays off, and the power of compounding is the key to understanding why. Compounding causes your money to expand exponentially. And the impact is stronger the longer you hold an investment. The general rule is that money grows more effectively the earlier you start. Number 4. Switch investments as your priority changes. Perspectives and priorities shift as one gets older. A typical man in his 20s doesn't even consider anything other than what t-shirt to wear, what automobile to drive, and how to attract women. However, the man in his 40s no longer cares about these inquiries. Your assets should adapt as you mature and as your financial demands do as well. When you are younger, you might consider investing your money in high-risk, high-return ventures. But as you get older, it is preferable to take a more cautious approach and protect the wealth you have laboriously accumulated over the years. Literally speaking, it refers to a change from equity-oriented to debt-oriented funds. Number 3. Don't put all your eggs in one basket. Never get too fixated on a single investment. Instead, be open to several investment strategies at once. Diversification is the most commonly used term in the investment world. Simply expressed, it advises the investor to spread his money among a variety of investments, including bonds, stocks, real estate, and commodities. By reducing the likelihood that you will lose all of your money if one investment fails and providing you with backup plans, this is one of the finest methods to build your money. Number 2. Be consistent in your investment. Even though they may make a great lover, moody people are poor investors. Nothing compares to the vices of excessive and inadequate investment. For the majority of us, it goes like this: we get incredibly thrilled about a certain investment, place our hopes and dreams in it, and then, before giving it time to develop, we withdraw our hands away. Humans have a tendency to go into something headfirst, then give it up after a few months. Whether it's investing, learning a new language, or starting an exercise regimen. However, in the case of investing, this practice directly costs you money. You must avoid such behaviors if you want to increase your financial situation. The dollar cost averaging effect is what causes money to grow over time when invested consistently. In layman's terms, it refers to average out the market's short-term ups and downs over the long run. Dollar cost averaging allows consistent investors to benefit from respectable returns despite market volatility. Number 1. Say no to debt. Many people compare debt to marsh. They take on additional debt in an effort to pay off their existing debts, which only makes their financial problems worse. In the end, it's the habit that counts. Make it a habit to never take on any more debt, no matter what. It's arguably the largest obstacle to being wealthy for the majority of us. Pay off all of your debts, from little credit card payments to large loans, before you start investing. Then, make a commitment to form the habit of delaying taking on new debt unless it is absolutely essential. Don't even consider investing until you've lifted the burden of your debt from your shoulders. When you are debt-free, you should start saving up liquid funds to cover your immediate needs. You won't be ready to make an investment until after that. You can increase your wealth without incurring debt in this method. What do you think of our video? Feel free to share your thoughts in the comment section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.